January 7th, there was cash purchases. Purchases is when you buy something. So in this case, you bought something and you paid in cash. January 7th, effect. So since you bought something and you paid in cash, it means your assets in form of cash is going to reduce and your purchases account is going to increase. So we're going to have increase in purchases. So we're going to have purchases accounts, and there's going to be a decrease in assets, which is your cash accounts. Action required. Which account do we debit and which account do we credit? Here, cash accounts is given to purchases accounts. So we're going to debit purchases accounts and we're going to credit cash accounts. This is the giver, this is the receiver, and this is the giver. January 8th, he withdrew check for private use. Check here, remember, anytime we have check, it means we are dealing with a bank account. And here again, we saw for private use. Anything that is not related to the business is going to be referred to as drawings. So the two accounts involved here would be bank account and drawings account. Effects. There is an increase in drawings and there is a reduction in assets because bank account is given to drawings account. There is an increase in drawings. So we have drawings account and there is a reduction in bank, that's in assets in form of bank accounts. So action required. How do we record this transaction in our books? Debits, credits. Which account is given and which account is receiving? So bank account is given to drawings account. So we debit drawings account as the receiver and we credit bank accounts as the giver. January 9, we drew 150 naira cash from the bank for the office use. The previous one was for personal use, so that was why we had drawings. But because this one is for office use, the two accounts will just be bank accounts and cash accounts. We drew cash from the bank, so the assets in the bank is reducing and the assets in form of cash is increasing. Effects. There's a reduction in assets, that's the one in the bank, that's the bank account, and there is an increase in assets, that's in form of cash account. Action required. Debit, credit. So since bank account is given to cash accounts, so we are going to debit cash accounts and we are going to credit bank accounts. This is the receiver and this is the giver. January 10th, received loan 1,000 naira cash from Tracy. What's the effect of this transaction? So Tracy is given to cash in form of loan. The effect, so there will be an increase in assets because Tracy gave cash, increase in assets, and these assets will be cash accounts. And there will also be an increase in liability because of the loan. Let's say the proprietor was not able to finance some things in the business, so he had to get extra cash from Tracy. We're going to have loan account. The loan account is Tracy, is given to cash account. Let's see the action required in recording. So debit, credit. So cash account is receiving. So we debit cash account as the receiver and we're going to credit loan account in the name of Tracy as the giver. January 13th. What happened? Put cash 6,000 naira into the bank. So the two accounts involved here are cash account and bank account. Put 6,000 naira cash into the bank. So bank is receiving and cash is given. So the effect. So there will be an increase in assets. And this increase will be the bank account because cash put into bank We're going to have a reduction in assets. That's because we will not have enough physical cash. So our cash account is going to be reduced. So action required, debit, credit. So cash is given to bank, so bank is receiving and cash is given. January 15th, effect. What's the effect? Purchase goods 100 naira on credit from Mr. Morgan. So the two accounts here will be our purchases account, and then it will be Mr. Morgan's account. So there will be an increase. There will be an increase in purchases. So that's our purchases account. And there will also be what? An increase in liability. And that is Morgan account. Action required. Debit, credit. Purchases account is receiving and Morgan's account is given. January 16th. January 16th, sold goods 503 naira on credit to Mr. Ajayi. So we'll have Mr. Ajayi's accounts and we're going to have sales accounts. So that's the two accounts involved. So let's analyze the effect of that transaction. There will be an increase in assets whenever there's sales. When you make sales, you are expecting an income in return. You are expecting cash in return. Even in situations whereby there is no immediate exchange of cash, there is still an expectation. You are still expected to receive cash after a stipulated period of time. So there is an increase. There's an increase in assets. That is Ajayi's account in this case. He's the one to give us that. And also there was an increase in sales because we made sales to Ajayi. So that's sales account. So let's see the action required. Debit, credit. So sales account gave to Ajayi's account. Ajayi's account is the receiver and sales account is the giver. January 19th, Ayo returned goods worth 15,000 naira to us. The us here is the business. Ayo returned goods back to the business of the company. And Ayo in this case here is a customer. Ayo bought goods from the company. Maybe after he got home, he discovered that the goods were damaged. So he decided to return some of them or even all of them to the company. So he returned goods worth 15,000 back to the company. When a customer is returning back to the business, we refer to this as return inwards. What's the effect? So there's an increase in return inwards. There's an increase in return inwards. So therefore have a return inwards account. Also, there's a decrease in Ayo's account. Let's say that Ayo bought goods worth 30,000 initially. He bought goods worth 30,000 naira initially. And now he's returning goods worth 15,000 back to the company. So there will obviously be a reduction in his account. His current balance with the company now, in the company's accounts, in the company's books, Ayo's accounts will now reflect a reduction of 15,000. So action required. Debit, credit. So we're going to debit return inwards, since return inwards is receiving. Return inwards accounts. We're going to credit Ayo's accounts. So this is still the receiver and this is the giver. January 20th, say goods worth 30 naira were returned to a supplier, Ojo. Goods worth 30 were returned. In the previous scenario, we saw that Ayo returned back to the company. In this case, the company is returning to a supplier. That's Ojo by name. So in this case, this return is regarded as return outwards. So there are basically two types of returns. So the first one is return inwards and the second one is return outwards. So return inwards is when a customer returns back to the company or to the organization, and return outwards is when the business itself returns back to its suppliers, maybe because of damages or anything. So what's the effect of this transaction? Goods worth 30 naira were returned to supplier Ojo. So there is a reduction in Ojo's account. And two, so we're going to have Ojo account, remember, and we're going to have a decrease in returns outward accounts. So action required, debits, credits. We're going to debit Mr. Ojo's account and we are going to credit return outward accounts. January 25th, say received commission by check. A commission is an income to the business and we received it by check, that is bank. So we'll have bank accounts. What's the effect? There will be an increase in assets. This assets is bank accounts, and there will also be an increase in commission accounts. Action required. From the rule we're meant to memorize, we saw here that whenever there is an item of income, we're meant to credit it. So that's exactly what we're doing here, because income is increasing the assets of the business. So we're still going to debit. So here, commission is given to bank accounts. So we're going to debit bank accounts with 80 naira. And we're going to credit commission accounts. Commission account is the giver. This is the receiver.